Hello class, this is Dr. Fenton. In this chapter, we are going to talk about stockholders' equity. Now, the stockholders' equity section of the balance sheet is comprised of three main areas. The first one is paid-in capital, and of course this is the amount the stockholders have invested in the business. So when the stockholders purchase shares of stock from the corporation, that represents paid-in capital. The next section is retained earnings. This is the amount of the net profits, the earnings, that have been retained in the business and have not been paid out as part of dividends. These have been retained in the business to either pay off debt, to expand the business, or to use for other sources. Treasury stock is an area that represents the corporation purchasing back its own stock. So when a corporation sells common stock, that amount goes in paid-in capital. When the corporation purchases that same stock back, its own stock back, then we classify that as treasury stock. And as we're going to see later, treasury stock is a reduction in the stockholders' equity amount. Here is a partial balance sheet, and of course this is the stockholders' equity section. Now, corporations can have two kinds of stock, preferred stock or common stock. Now, they always have common stock. That's the most basic form of ownership. But preferred stock is available that corporations can sell. We'll talk more about that in just a few minutes. The additional paid-in capital account represents the amount that the common stock or preferred stock was sold for above its par value. After you compute total paid-in capital, we have retained earnings, and we've seen that before in other chapters. Then here's where I was talking about we will subtract the treasury stock amount. And so if we paid, like it says here, $965,566 for treasury stock, that's a reduction in the stockholders' equity balance. So total stockholders' equity with these numbers, you can see the $1,139,746. Now, stockholders have various rights. First of all, we're talking about common stockholders for the most part. They have the right to vote. So on corporate matters, they can vote. There are annual shareholders meetings they can go to and cast their ballots, and usually it's like one share equals one vote. They also have the right to receive dividends, but this is only if the corporation declares and pays dividends. And also they have the right in the distribution of assets. This comes into play when the corporation is dissolved. And whatever's left over after you pay the creditors, then the rest of it is paid out to the stockholders. There are some disadvantages and advantages of corporations. The first advantage is limited liability. Now, this limited liability relates to the shareholders. Let's say there's a huge lawsuit in the company, and maybe it's so large that the company ends up going out of business. The damages awarded were so large. If the corporation was handled correctly, if the corporate structure was handled correctly, then the shareholders are limited on what they could lose, and they're limited to their investment. So if it's a corporate lawsuit, against the corporation, and the corporation loses, then the shareholders' personal assets are not exposed, just the corporation's assets. Also, it's somewhat easy to raise capital and transfer ownership. You sell more shares of stock, you can sell your stock to someone else. So the transfer of ownership is very, very simple. For disadvantages, we do have additional taxes. There is a corporate tax level, and then when the after-tax dollars are paid out in the form of dividends, those same profits are taxed again. So some people call this double taxation. Also, there's more paperwork involved when you have a corporation, setting it up and running it, and also trying to dispose of it. As to stock, we have the authorized shares, which means the corporation is authorized to sell a certain number of shares, and the state will agree to this amount. The corporation applies for it, but that's the maximum amount of common stock shares or preferred stock shares that the corporation can sell. When it sells these shares, these shares are called issued. They've been issued to the shareholders, and so they are also called outstanding shares. The remaining shares not sold yet are called unissued, of course. Then, as I said earlier, the issued shares are the ones held by investors, called outstanding shares. If some of those issued shares are repurchased by the corporation, so in other words, the corporation is buying back its own shares of stock, that goes into treasury stock, and those shares are not considered outstanding. Just the shares that have been issued and not purchased back are considered outstanding shares. Authorized shares, just talked about this, available for sale, issued, they have been sold, outstanding, they are still held by outside investors. Par value is a concept that applies to common stock and also preferred stock. This is a legal capital per share that's been assigned to the corporation when it is first established. Again, when they file the corporate charter, the articles of incorporation, the corporate charter will be issued, and the common stock will have a certain par value attached to it, and it can be $10 a share, $1 a share, 1 penny a share, or even less than that. Some states, though, don't require a par value, and that would be no par common stock. One thing to remember is that par value has no relationship to the market value of the common stock. And that is a common mistake. They think par value equals market value. It does not. Preferred stock, this is a separate classification of stock that has various features that the common stock does not. The first one is convertible. Possibly those shares can be converted into common stock if the preferred shareholders would like to do that and when it is advantageous to them. Redeemable. The corporation may be able to call back these shares of stock and pay the shareholders off, of course, but they could be called back at the option of the corporation. They could be cumulative. That means when dividends are not paid to the preferred stockholders in a certain year, then they must be made up when dividends are paid again. Treasury stock, again, this is the corporation buying back its own stock. And they'll do this for various reasons. They want to boost underpriced stock. They think the price on the market's down too low. The corporation will buy it back. And with less shares out there, the price may go up. They might want to distribute surplus cash without paying dividends. So they're buying the stock from the stockholders and getting cash out the door to those stockholders. And also boost earnings per share because you'll have a lower amount in the denominator, fewer outstanding shares, and that will increase the earnings per share amount. Also, they might have to have shares of stock on hand to place into these employee stock ownership plans. Cash dividends, these of course are distributions by the corporation to the shareholders. They are part of the profits being paid to the shareholders, and it can be quarterly or annual cash dividend, depends on the company what they would like. But not all companies pay dividends, so dividends are not guaranteed. Even to the preferred stockholders, dividends are not guaranteed. There are 3 dates. The declaration date, that's when the board declares the cash dividend will be paid, and the dividend becomes a legal liability at this point. The record date, this is the date to which the company will determine who owns the stock. So whoever owns the stock at the end of this date, the record date, that's who will receive the dividends. Then there's the date of payment, and this is the actual date that the cash is distributed, usually sent out in the form of dividend plans or deposited into mutual funds. Now, return on equity, one of the ratios in the chapter, this shows how well the company is generating income compared to the stockholders' equity that the shareholders have invested in the company. Dividend yield, how well is the company paying dividends compared to the stock price? So if you purchase stock and you're after dividends, then what you might want to do is look at a dividend yield for a company to see if it generates 3, 4, 5% dividends compared to the stock price when you buy it. Earnings per share, a very commonly quoted financial item in the news. This is net income, and you would subtract from net income dividends on preferred stock if the company has preferred stock. Then you would divide that by the average shares of common stock outstanding. So as I said before, this is a very commonly quoted number in the financial world. This is another one, price earnings ratio. This compares the stock price to the earnings per share. The more the investing public has in confidence in the company, the higher this number will be. And that's about it. One other thing to remember is that any examples with numbers are given in videos, so you can take a look at those. So good luck with your studies, and I will see you in the next video.